We have two different sets of rules for on exchange and off exchange that's facilitating this. The real driver of this bilateralization is people wanting to segment order flow and filter out all the non-toxic and just trade with somebody that they know is not going to run them over and harm them. And it's really, really difficult for an exchange to facilitate that because they are subject to fair access rules as part of the Exchange Act, and off exchange is not. So that's one reason why you've been seeing retail to wholesale, or this institutional migration that we've been talking about more recently, the off exchange market share going higher and higher.
That also ties into the SEC is probably imminently going to be changing Rule 611. How venues look at the exchange and ATSs, that may also be something that the SEC addresses too, relaxing their ability to own ATSs and operate ATSs, and possibly looking at the fair access rules, especially as it relates to the hidden dark liquidity on exchange.
When did the rebilateralization of U.S. equity trading begin?
It's hard to pinpoint exactly when it began. It's been going on for several years, and it's taken a few different forms. Probably the one that most people will be familiar with is back in late 2019, early 2020, when we saw a really big increase in retail participation in the markets. And that's because most retail orders are internalized off exchange. That's a bilateral trade. It's called retail to wholesale. You have what's known as a wholesale market maker sitting on the other side of that trade, receiving it from a retail broker, internalizing it in most cases, and in other cases, routing it on somewhere else to get a prompt execution. So we saw off exchange trading go up quite a lot, particularly the percentage of the overall volume in the market that got done off exchange increased a lot because of that. But what we've observed more recently is that retail participation kind of peaked in early 2021 into 2022, backed off a little bit. It's still significantly higher than it was before late 19 and early 20 with zero commissions and COVID really increasing retail participation. But it's leveled off. It's been kind of stagnant for a while. And what's happened instead in the past 2 or 3 years is there's been more institutional order flow moving into these bilateral channels like single dealer platforms and private rooms and ATSs.
What is the size of trades moving into these bilateral channels?
It's difficult to pinpoint exactly because, unfortunately, there aren't perfect data on this, and we'd love for there to be more data out there that we can analyze as market structure analysts. If you look at some of the components, single dealer platforms are probably the biggest one, where a lot of this move of institutional order flow from more multilateral or slightly segmented markets into very highly segmented or bilateral channels is occurring. Their market share has roughly doubled over the past several years. I think that's around 6% now of total equity trading, and it was maybe 2 or 3 back at the beginning of that period, roughly 2019, 2018. The other piece is a lot more difficult to pinpoint, and that's what's happening in private rooms in ATSs. There's one large ATS, Intelligent Cross, which actually does disclose how much of its volume, and it's the biggest ATS in the country. I think they said 9% of their volume in the most recent calendar quarter came from private rooms.
Private rooms are these side pockets within alternative trading systems. They're highly customized, generally one-to-one interactions within the ATS that you know the counterparty that you're trading against.
What is driving the growth of single dealer platforms?
These pools have become much more sophisticated over the years. They kind of started as these blind ping pools. There was a lot of hesitancy on the part of institutions to interact with some of those market makers because just blind pinging them, there was a chance of information leakage and usually low fill rates. As the SDPs have become more sophisticated, they typically generate indications of interest that they stream out to brokers so that they know whether or not there's activity in there that they could potentially trade against. With that sophistication, the fill rates have gone up, and a lot of the institutions find those as valuable sources of liquidity.
Another interesting aspect of this, there's been not only a change in the nature of the liquidity providers, the market making firms that operate these single dealer platforms, but also in the relationship between them and everybody else. I think back to my early years at Rosenblatt, right? After the financial crisis, and when people started to discover what was then called high frequency trading, right? And a lot of these newer generation market making firms, there was a lot of hesitancy, particularly on the part of institutional investors, to interact with some of these firms. And we tried to explain at that time, look, these firms are just the latest generation of what has existed in the marketplace for a long time, which is a systematic liquidity provider, a market maker. They just do it differently, and you've probably never heard of them because they only got started relatively recently. And at the time, they were trading mostly on exchange, and they were trading in very small size. These firms have gotten a lot bigger over the past almost 20 years, and they've evolved their strategies. They're increasingly looking to trade, lower frequency strategies, looking to trade in greater size. And I think the institutional investor community has gotten a lot more educated, whereas 15, 16, 17 years ago, there was a lot of paranoia and people feeding that paranoia about, oh my God, we don't know who these people are. You don't want to trade with them. They have an unfair advantage. They're toxic. They're predatory. Now you see the institutional investors a lot, in a lot of cases, the very same firms self-segmenting their order flow and saying, I have all of this relatively low toxicity order flow, relatively uninformed order flow, maybe the end of a big order. There's these big liquidity providers out there that would love to interact with this because they would, and just do it bilaterally. They know who I am. They know the flow is not toxic. I'm going to self-segment and go right to their doorstep now. Forget about like worrying about who they are like I did 15, 16, 17 years ago. It's been a very interesting transformation.
How does block trading fit into this trend?
We've seen block trading overall kind of decrease, particularly on ATSs over the last several years. To kind of fill in some of those gaps, we've also seen an increase with single dealer platforms increasingly being able to offer block trades. Some of those market maker firms are being able to trade over longer periods of time, being able to kind of offer blocks to some of these firms, and also just knowing the counterparty helps them to be able to facilitate more blocks as well. I think it's also important to note it's not just the SDPs with the most recent announcement from Citadel. They're also trying to get into more of the high touch block business. So it's definitely moving in that direction with market makers being able to offer more blocks in various forms.
How has Citadel's expansion into other business areas influenced these market changes?
There's definitely a bit of a turf battle that's starting to happen here. And this is something that we've been thinking about for quite some time. And a lot of the players involved will try to downplay it. If you just look at the trajectories of this newer generation of market making firms that has come into the market roughly in the past quarter century and uses technology and makes markets in different ways that fit the way technology and market structure have changed since then, compared with the old way of doing things at banks and some of the other non-bank firms that were the big market makers in the manual world. They've kind of been on a collision course, right? A lot of the older generation withdrew from those activities as the market structure changed, as technology changed, as the financial crisis put constraints on their balance sheets. And at the same time, this newer generation came along and it's just been getting bigger and bigger and bigger. And maybe they started trading futures, or maybe they started trading US equities, but now they trade everything everywhere in the world. To keep getting bigger, they start doing things that are maybe further afield from what they started doing and just, trading something electronically. And they're looking at things that banks and more traditional financial institutions have done, like starting a high touch trading desk, thinking about getting into maybe aspects of capital markets or underwriting one day. And I really see that playing out over the next maybe 10 to 20 years. For now, there's a bit of like co-opetition that happens, or maybe some of those other firms, the banks and the more traditional entities are starting to fight back a little bit and launch their own like quantitative trading groups, or just be careful about how they interact with the newer generation firms. But there's definitely I think a clash that's starting to happen there.
As they get bigger and trade, across different asset classes, they can also become more sophisticated in how they kind of allocate risk. So going back to your question around kind of block liquidity, that's also contributing to their ability to trade blocks too.
How do ETF-RFQ platforms fit into these trends?
We kind of try to break out some of those off-exchange components. The ETF-RFQ business is a little bit difficult to kind of put hard numbers around, but we have seen that grown and heard about it growing for over the last several years. The ETF business in general has been growing a lot, and these bilateral RFQ platforms have been growing as well over the last several years. They're also dominated by market makers, but we're starting to see banks get more involved in that space as well.
What is the future outlook for these trends?
I think what we're documenting right now is kind of the early stages of this trend. When we speak with people who are on the field of play and engaging in these practices and trying to segment more and more of this order flow into these bilateral silos, sometimes we hear comments like, okay, right now we're at 50-50 between on exchange and off exchange, and that's up from 70-30 or 80-20 not that long ago. If all of this works the way people think it's going to work or hope it's going to work, maybe we'll be 70-30 off exchange, on exchange before too long. And that's where you start to think about there are competitive implications. What do exchanges do? Because they've already been losing market share to off exchange. And the competitive environment for them is the most difficult that we've seen, I think in the modern market structure era. And we did another piece on that not that long ago. But even beyond that, if you just think about why markets exist and the core kind of price discovery function that they perform, what does it mean for that? That public quote is kind of the bedrock of markets and determining that most accurate price for the end users of the marketplace, for asset owners and issuers, is why the markets exist. If that public quote keeps getting thinner and thinner, nobody wants to interact in these multilateral markets because they feel like they get better outcomes if they can isolate a counterparty and say, well, I know who you are, you know who I am. The liquidity provider can make a tighter, bigger market. The liquidity consumer benefits from that. Yay, we get better outcomes. But meanwhile, what's happening to the quote? Better than what is the question, right? If the market is getting worse, and it's really hard to determine that, but the fear is that maybe the markets do get worse, that price discovery isn't quite as accurate or robust as it once was. And if we keep going down that road, how do we know when you cross the line? I think it's very difficult to determine. We've talked about academic studies that have looked at this and in different parts of the world, and it's the kind of thing that probably varies too, from market to market, even from stock to stock. Very difficult to pinpoint, but I think a very important question that we should be thinking about. The tendency is everybody just tries to pursue their self-interest and get that what they think is that better outcome, but we don't really take that step back and worry about the larger issues at stake.
How will the tokenization of equities influence the bifurcation of equity markets?
I don't know that it's going to play into the bilateralization trend that we've been talking about necessarily. And as far as I think we can tell so far, it seems like there's a fear on the part of some of the existing exchanges that other players, maybe crypto native players that don't see markets the same way as incumbents do, that look at the rules that we have in place and the structures that we have in place as bugs rather than features, right? And want to just reinvent things, and crypto should be different and should be exceptional. You see a lot of players out there where they're the execution platform, they're the broker, they're the custodian, all wrapped into one, and that's not something that happens in the regular equities world or the traditional equities world. And I think probably for a lot of good reasons, the traditional players see what's happening outside in that other world, and that the political environment, regulatory environment in particular right now is extremely accommodating to those players. And they worry that their existing business is going to be cannibalized. So there are some efforts being put forward by those players to say, look, if you want to do tokens, we can do tokens, but let's do it the same way that, with the same general infrastructure and rules and protections for end users in the marketplace that exist for equities. Let's get whatever benefits there are. I'm a little skeptical about whether those benefits are really that material and worth a lot of the other things that go along with tokenization. But I think their thinking is we can extract some of those benefits without all of the other risks that might go along with doing tokens the way maybe some other folks are envisioning.
What will be the focus of your next research report?
I think tokenization is one of the things that we've been looking at for different reasons. We did a piece on private rooms first that, got a lot of attention on the street last year. And that was just sort of one piece of this larger trend, I think, of rebilateralization. So we decided to address the larger trend. Tokenization is something we're thinking about. I don't know that we want to necessarily commit right now to doing a full-blown piece on it, but that's certainly one of the topics that we're looking at.
And we did a piece too about last year is 24/7 trading, or overnight trading, extended hour trading. And it kind of goes hand in hand with the tokenization as well, being able to kind of trade at all hours. Later this year, with the SIP being able to trade or being open overnight starting in December is the time frame that they've given, and many exchanges will start trading as well overnight. Then I think it's something that we're following closely, and we'll see where it goes.